Welcome to a long-awaited video. This has actually been way too long, like way too long. But I'm gonna get right into it. I'm not even gonna waste your time. I know you're here for one thing and one thing only. This is an options trading breakdown, which should be really simple, really easy. I think you'll really understand it once I break it down. I'm really used to breaking this down. I'm gonna make it super quick. My videos usually aren't that quick, but I'm gonna make it super quick this time. And yeah, let's get right into it. Okay, so yeah, I am going to be looking at this side for most of the recording, only because it's where my computer is, but I am screen recording my entire screen. I'm on Robinhood right now because Robinhood's the easiest platform for beginners. I personally have never had a problem with them, although some people don't like them. You can use any brokerage, just whatever you're comfortable with. But first thing you want to do when enabling options trading, you'll want to go to the account. When you go to the account, you're going to see settings. In settings, you're going to go to account. And then you're going to scroll down. It's going to say get options trading. And then you will be able to get options trading. So I'll ask you a couple questions. You know, you want to at least know what you're doing. But when you do tell them, okay, yeah, I know what I'm doing, they will approve you. If you look like you don't know what you're doing, they're not going to approve you. So if you know what you're doing, don't act like you don't. And if you don't know what you're doing, you should probably learn just a tiny bit. But I'm going to break down how to enter a trade and what it all means. Really simple. This should be a super short video. So yeah. Okay, so first thing to know about options is that it's similar to a lot of math. That's how I tell people. I say options is like calculus. It deals with a lot of derivatives. It runs off risk. It runs off volatility. It runs off all of that. So when people ask me what is an option, this is not the immediate definition. The definition that I like to give them is it's similar to getting the right or borrowing 100 shares at a discounted price because you're holding it for a limited amount of time. That's very important. It's very critical because you're not holding it forever. You're not getting 100 shares for free. So the way I like to put it, right, if we were to go to Apple, okay, Apple is currently at $143. We'll round it down to about 140. If you wanted to buy 100 shares of Apple right now, which you could really just do that right here, 100 shares would be equivalent to about $14,000. But if you wanted to do options, you would be able to buy it for as cheap as $100 or really as cheap as, I don't know why this screen won't move down. Okay. But really as cheap as, if you can see down here, 19 cents per share, $1 per share. So you could buy it as cheap as 19 cents per share, $1 per share. And I'm going to explain why that works and how that works. Okay, so we are back on Apple. First thing to know when it comes to the stock market. I have, if you really want a full breakdown for beginners, well, an easy breakdown, I do have a small guide. It's short, like 30 pages. It has quizzes. It really walks you through it so you can understand. I have that in the link in my bio. But for right now, I'll just briefly break down to you what a stock is. So a stock is a publicly traded company. So a lot of companies are private. When you're public, you IPO on the stock market, or you could do it through a SPAC merger. But Apple, right, is a company, okay? 143.01, that is the price it is currently trading at. So if you wanted to buy into Apple, think of it as one large pie, okay? So you have one large pie, and if you buy one share, you get a tiny sliver of that pie. And the pie has a total amount of shares. Now some of those, or total amount of slices, the pie has a total amount of slices. Now some of those slices are already taken, and the ones that aren't taken are called a float. So the amount of shares available, or the amount of slices available. So you have the chance to buy one of those slices, and you can hold it for as long as you want. You can profit off of it. Maybe it gets a little bit of mold and you're like, I want to sell it. Or maybe it starts glittering and then it turns to gold and now you can sell it for a lot. You know, so it really depends. It really depends on you. But in this case, that is what a stock is. It's a publicly traded company like Apple, Microsoft, Amazon, Tesla, the whole lot. Some things to note about them. Some companies will give you dividends, which is when they pay you to invest in them. So if I have one share of Apple, my dividend yield is 58 cents. If I had 2 shares, my dividend yield would still be 58 cents. And you'll usually see dividend yield because dividends can fluctuate. So dividends, like, okay, so for example, let's say, for example, Coca-Cola, they pay on average around 40 cents per share. So if I had 2 shares of Coca-Cola, they're going to pay me 80 cents for holding that share. Now, some companies will do it quarterly. Some companies do it monthly. A lot of people like AT&T because they have high dividends. So does Coke. It really depends. You also don't want, though, a stock that has high dividends but is not actually producing returns. So, for example, just for me to go on here, if you go to AT&T, as you can see over the past 3 months, well, it was doing pretty good in May, and then it dropped, and it's been stagnant over the past year. It's down $2. Over the past 5 years, it's down $15. It's terrible. Now, if you invested in this, yes, you have a severely high dividend yield. However, well, you're probably not making as much money from dividends as you're losing on the actual stock. So that's why I say you do want to get a stock that will produce you a return. Okay, so another thing to keep in mind when it comes to stocks is market cap and volume, because they work hand in hand. So as you can see, Apple has a $2.39 trillion market cap, which is giant. When it comes to market cap, a small cap company, you're looking at around 300 million to 2 billion. 2 billion to 10 billion is what we would call a mid-cap company, and 10 billion and above, which, you know, Apple is definitely there, is what you could consider a large cap company. And then how volume works is who's actively trading that stock. So it doesn't really matter if you're holding long term, but if you are trading options or so, then it is something you want to take into account, because the low volume probably means low activity. It's harder for the stock to move up or down, and you know, with options, volatility matters. And if it has high volume, that's really good. It could indicate, oh, this is going to make a strong move, or it could indicate a direction that it's going. And it could also tell you to trade or not to trade that current stock. So the way I could describe it, right, imagine this is a small cap company, imagine this as a mid cap company, and then imagine this as a large cap company. Okay, so I'm going to try and put them all here. Okay. I don't know why small cap looks bigger than mid cap, but small cap is smaller. So with the more volume, right, it can contain a lot more. But notice how right here with small cap, it's overflowing. That's a good thing, because if there's too much volume, it means there can be a large movement. Now with mid cap, notice how it can contain everything that small cap has, and it still has a little more room. But if I was to add large cap, it's not going to work out. But if it overflowed, good news, higher volume than usual. That usually means the price can make a direction in a certain area, up or down. And then for large cap, it can contain everything, because that's what it does. But if you get a large cap company to overflow, that movement can be severe. But naturally, larger cap companies have a lot of volume. It's the small cap companies that you really like. That's why people will trade penny stocks and get hundreds to thousands of % returns, because if there's just enough volume, this thing can go flying. So that's just something to note. Okay, so now what I'm going to just briefly go over is the key statistics. So the high today is the highest price it was at today on this current trading day, and this is Thursday, July 8th. The low today for Apple was 140 and the high was 144. So what it can tell you is Apple either shot up or it shot down on that given day, if you're just looking at statistics only. Open price means when market open, what did Apple open at? 141.57. And its 52-week high is the highest it's been in the past 52 weeks or a year, which is 145.09. So it's pushing close to its all-time high, or not its all-time high, its 52-week high. And its 52-week high is the highest Apple has been in the past 52 weeks, which is 1 year. And as you can see, the highest it's been is 145.09. So it's pushing upon that. I personally had it going to 144, but I could see in an earnings rally, it can shoot right past that and make a new all-time high. Its 52-week low has been $89.15. Do keep in mind, though, Apple previously had a stock split last year, 2020. So these are prices that are adjusted to the stock split. But now let's get into the fun business. And here's how you can tell, Apple was going up, and then decided to come. Oh, well, it relaxed a little bit. But as you all came to see the options breakdown. I just had to do a brief stock one. This is very brief. This is not very in-depth. I know people come on YouTube, they want short videos, so this is what I'm trying to give you. This is where it can get very confusing, so I want you to get your notebooks out, get your pen pads out, take notes if you need to. I'm going to go over this very briefly. I'm going to make it very quick, so let me go ahead and do so. First thing you would do once you have options trading enabled, you would go to the stock, you press trade options. You can do this on your phone too. I'm just not currently on my phone because that's what I use to record. But you could also do this on your phone. It's the same thing. It's actually a lot easier. I'm doing it on the laptop just for you to see it clearer. So what you would do here, it's going to show you Apple's price because that's what it does on the laptop. But what's important to note is the current expiration. So first thing I'm going to explain a call and a put. What is a call and a put? So a call is when you think a price is going up, so you want to profit on it moving up. A put is when you think a price is going down, so you want to profit off of it going down. The way I always put it is you pick up your phone to call, so call goes up, and you put down your phone, when you're done with the call or when you want to hang up. So you put down, so puts go down, and you pick up, so calls go up, because you pick up your phone to call. That's how I always tell people. I think it's super easy to understand it that way. Back into the good business though. When you're buying a call and a put, it's standard options, real simple. When you're selling, this is when you would have to put up collateral because you're usually owning 100 shares. This is when you'd use a covered call or a covered put. For this video, we're just going over buying calls and puts because a lot of people don't have 100 shares. That's why they're trying to build the capital through options, which can be very lucrative if you utilize your risk management properly and if you plan it properly. So, again, with how can you buy an option for $1 a share or 62 cents a share and still profit, get 100% returns, 200% returns, 300% returns, stuff you wouldn't see from the S&P 500 in a year, which the S&P 500 is up 50% since last year, so that's actually crazy, well, since it's low last year. But anywho's, as we get right into this, so a couple things I'll highlight. This right here is called a strike price. A strike price, most people would say, oh, this is where you think the stock is going. So if I think Apple will go to $147 by July 16th, well, I'm going to go ahead and buy $147 strike price. That is not always the case. I always tell people, you don't have to see it that way as long as you know the Greeks. We'll get into the Greeks in a second, but I'm going to continue to break this down. Break even is when you can now exercise your contracts. Exercising is just whenever you actually buy the 100 shares, but you get to buy it at a cheaper price, of course, and not at the current price it is. And then it just tells you the percentage to break even, to be allowed to break even. And the percent change is how much it changed for the day, or on that given day, per percentage. So today, the $147 strike price was down 33%, or a third of what it was yesterday. And that is equivalent to a 41-cent change, which is a lot of money. Just think of it, if you had $100 in, that's equivalent to losing $30. If you had $1,000 in, that's equivalent to you losing $3,000 on the day in that given contract. A contract, you're about to find out, which I should have explained earlier. A contract is an options contract, so it's this entire thing right here. This is what you call your premium. So the premium is the amount you're paying for that given contract. So in this case, if I wanted to buy this right now, which the market isn't open, so I can't, but if I wanted to, I press the plus sign, be long call, I would continue. And as you can see right here, it says contract. And boom, right here, I'm paying $82. Now, what some people don't know is you can actually edit this. So let's say I wanted to buy one contract, cool. You could go ahead and you can see if you can get it filled at $80, and boom, you can almost get it. You can get it $2 cheaper, which, if you're buying 10 contracts, which I usually I don't usually buy 10. I'll buy like 100, sometimes maybe 5. It depends on how lucky I'm feeling. I don't know why I did this white box thing. Just going to do it normally. 10, that's $800, which is equivalent to saving $20 on your contracts. So that's why people like to edit it. It may not always fill, but that's also a way, if you're selling your contract, that's a way that you can also do it, is you can edit that. So let's say you were looking at the limit price. It said bid was 79 cents, and ask was 84 cents and you're selling, so people are asking for your contract, you can say, well, you know what, I'm going to sell it for 85. You know, that's also a way to set a stop loss. Let's say you're like, okay, well, I want to buy this and I want to sell it at $100. You can put at 100 and hope that they will sell it, Robinhood will sell it at $100 per contract. Quick question to reverse, what is bid ask? Because I know somebody's going to be like, Kelly, you're just talking. Well, when you're on your phone, that's when you're going to see, it's going to actually say bid ask, and I'm going to show you again how you can find that out. But the bid is the amount of people wanting to buy it. They're bidding on that contract, and the ask is what the sellers want for it. So the sellers are saying, well, we want 84 cents, and the bidders are like, I'll meet you 79. So what Robinhood will do to try and get you filled is they'll put you right there at 82 cents per contract, and they will say, okay, well, $82 per contract. They'll say, okay, you're in the middle, we'll hope you get filled. If you want to get filled immediately, you can definitely pay an extra $2 per contract, but nobody wants to pay more than they have to. So that's just how I would personally put it. I don't like to pay more than I have to unless I'm absolutely certain that where I feel really good that stock is going to go up. And that's when I'll be like, you know what, I'm going to make it bet. You know, it just depends on how good I feel about it. Or maybe a stock's moving really fast and you just want to get in. Sometimes I'll just match the ask so I can get in. So I'm going to break down what I meant when I said strike price. Let me zoom in here so you can see it a lot easier. Okay, so we're going to go back to this 147 strike price. If it'll let me. It's not letting me. Okay, we're going to zoom out a little bit. Cool. Okay, here's the 147. So I'm going to press on it, and it's going to tell me all this stuff. Let me do this manually. Okay, so the bid, as you can see, 20 people want to buy this at 79 cents a contract, and 17 people want to sell it at 84 cents a contract. This is really good if you're selling, if the bid is more than the ask, because you have a higher chance of selling it for more than you actually want it for, which sometimes I'll do that. So if I have a contract that I've already made really good profit, that I don't really care much about, where I know like I don't care losing a couple dollars, sometimes I'll mark up the contract price by $15 or 15 cents in that case, and it'll fill because a lot of people want to get in and there's not a lot of buyers, so they'll take it. So that's just what I would say. So when you have 79 cents and 84 cents, the mark is going to tell you what's in the middle. So the middle would be 81.5. Can't really get 81.5, so they're going to try and fill you at 82 cents, which you would see right here. 81.5 would not work. So I mean, you could always try 0.815, but they won't let you do that. They're going to round it up. You see how I press the 1.5 and boom, it rounds it to 8. It rounds it to 2. I'm not pressing that. So that's where it's marking it at, so it's going to round you up. Open interests are the amount of people currently interested in this contract. Volume is the amount of people currently trading the contract. Implied volatility is how volatile it could be. The higher is usually the better because volatility moves contracts a lot heavier, and your contract has a better chance of moving, which can make you profit more or lose more. You know, that's the risk you take. So the high for this contract was $1.09, but as you can see, it came down. It had a change. And yesterday it closed at $1.23, so that was $123 per contract. It's currently 82 cents, and its low was 41 cents, but it did reverse itself. So that is just something to note when you're looking at this or trying to read it and understand it. So here are my best friends. I like to call them the Greeks. The Greeks are why I say you don't have to pick a strike price that you think a stock is going to, because the Greeks matter. So the strike price of 147 is what we'd call out the money, because this is what you would call at the money or in the money, depends on how you want to put it. It's usually touching the share price, so they're going to be a lot more lucrative, and I'll explain how in a second. But this is what you would call at or in the money, and this is what you would call out the money. It's further away from the current share price. So if we go back to that 147 and we go to our Greeks, so write this down. Delta is the amount of money you make per dollar the stock moves up or the amount of money you lose per dollar the stock moves down. A lot of people care about it because obviously you want the stock to go up, unless you're doing puts, which we will get to in just a brief second. But that is what delta would be. Gamma is the rate and change per dollar the delta is moving up. And when I say dollar, I mean per like point, so like the cents that's moving up. Gamma is just how much you change. The larger the gamma, the better, because gamma is what's going to allow your delta to move. Theta is the amount of money you lose per day of holding that contract. It doesn't matter if the market's not open. Theta is priced in. You're not going to see it work. It just works secretly, and that's why I say options can be a lot of math, and it's a lot of hidden math that's calculating how you're making your money. But theta is the amount of money you lose per day holding that. So, Vega is your volatility. Vega works with implied volatility. So when implied volatility is moving up a point, Vega is also going to start moving. So it's how lucrative, I wouldn't say lucrative, it's how much, it basically affects the implied volatility, because I don't know the word that I'm trying to say. And then rho is what's changing based on the interest rate. So yeah, I always tell people Vega, rho, gamma, they work in silence, they work in secret. You won't really be able to calculate them because everything is constantly moving. And when you start trading, you'll start to see it. It moves live. I'm doing this video when the market is closed just so you can see it based on that. But I always tell people the main things to focus on are delta and theta, because delta is the amount of money you're going to make per dollar it moves up, and you want to make a lot per dollar. Of course, these can change because options run off risk and volatility. But if this was just a perfect options world where things did not change, this is how you would read it. Theta is the amount you lose per day. So I always tell people, if Apple was to move $1 on any given day, you would make $25 but lose $11. So in total, you'd make $14 profit. And if Apple was to move $2 on any given day, then you would do 25 times 2, which is around 50, but it's 25.48, so you're looking around 52, but I'll just use 50 for this case. So 50 minus 11, you're looking at about 39. So that is kind of how you would calculate it. Remember, theta is going to be invisible. It's going to take away on its own. You're not going to be able to tell, but it'll be doing what it needs to do. So that is what it would be on this 137 strike, or 147 strike price. My apologies. If you would go in the money to this 143, if you want to see what it, like, why people would buy 143 calls, because Kelly had already passed 143. So if I buy it, am I automatically in profit? So couldn't I just buy this 140 and then I would automatically make 400? No. That's not how it works. So we're going to go look at this 143, right? The Greeks of this. Remember, the Greeks for the 147 were 25 delta and 11 theta. And the Greeks for this 143, as we're looking at it, you have $52 per dollar it moves up, so 2 times the amount of that 147. And the theta is $14. But if you do the math, 52 minus 14, you're looking at 38, I believe. And if Apple was to move $2 on any given day, then boom, you're looking at around $104. Minus 14, you're looking at about $90. It'll probably be more based on how fast Apple moves, or if Apple is just slowly moving. Remember, volatility matters with options, and that's basically how you would look at it. And again, you can look at the bid ask. This person with an ask is going to be very happy, because they could probably put this at 235 and still get it filled, because there's 86 people that currently want this contract. So that's how you would look at it. Remember that this is also the amount you can lose. So yes, you're paying more. See, this is $231 compared to this was $82. You're paying more, but you're also running the risk of losing more. But of course, people are not buying into it to lose more. They're buying into it to make more, because the possibilities are endless. So again, that is just how you would look at the Greeks. That's why I say the strike price doesn't necessarily matter. You can honestly just pick it and calculate it based on how much you want to make, based on how much you're paying. So that's what I would say. Sometimes people will say, well, Kelly, I
got into this contract. I don't understand why I'm not making any money. And I'm like, okay, well, show me what contract you're in. And they're like, oh, well, I'm in an Apple 160 call for next week because Kelly, honestly, I don't know. I didn't have a lot of money, so I just wanted to play around with it. And I'm like, okay, cool. Let's look at the Greeks. And you're looking at it, and the delta is $2, and the theta is $2, and you're like, bro, you're not gonna make any money unless Apple starts shooting to the moon. And then it gets even worse when they start going for these cheaper ones. And again, $1. And then look, the gamma is really low, so it has a slower chance to move. Rho is really low. There's not a lot of interest. Vega is super low. Volatility. Well, it can actually be more volatile because of the fact it's not moving. But yeah, as you can see, these have lower percent changes because they don't move like that. But if you do get into these, you can honestly flip them like crazy. You really can, because think about it. If this $1 contract goes to $2, that's 100% return. So that's just how I would kind of put it. I'm going to do the put side, and I'm going to highlight the profitability when you're getting into an actual contract or when you're placing it. So just to highlight the dates, this is just how long you want to hold it till. I always say the expiration date is just a safety net, unless you genuinely want to hold it till 2022. But they're going to be a lot more expensive because, listen, Apple is likely to be way past 140 by 2022. So that's what they kind of base it off of. Remember, this is probability, statistics, derivatives, all of that plays a part in options. So what you're seeing right here is it's $13.35, which is equivalent to $1,335 per contract, because stocks usually go up. Apple more than likely is going to come out with a new iPhone. They're going to come out with new products. They're going to have Apple Day. So this is more than likely going to go way past 140 by that time. Maybe it'll be at 200, and this will be severely in profit. So that's why they're saying by 2022, come on, man. You know it's going to be in profit. We're not giving it to you for a cheaper price. Options run off a risk. This won't be as profitable as the one expiring next week, because options want you to be a lot more risky for some reason. But yeah, so this is just what you kind of look at. But you could buy this contract just because, hey, I want Apple to go to 150, but maybe Apple doesn't go to 150 next week. Maybe it won't go to 150 for the next 2 months, but I don't want to lose my money. So I would rather pay more to guarantee that I'm going to make the money or make a return on my investment by a certain date, rather than, buy an expiration for next week and it doesn't do what it needs to do. So that's just kind of how I would personally put it.
One thing that I want to emphasize upon is theta decay. So your theta gets heavier closer to the expiration date of your contract. So please, please, please do not hold your contract until the expiration date comes, because it will really start to eat your contract and get rid of your profits. It's going to really become heavy because that thing has to expire worthless, or you need to exercise it. So another reason people buy long-term expirations is because they want to avoid theta decay, because the theta will be super low. I had a Riot contract. It was super in the money. I mean, Riot was like $30. I mean, it went up to $60, but it was at $30. And I had a $15 call for 2022. The delta was 99. The delta was 99, and the theta was 0.0001, so 1 cent. So I was making a ton of money, but if Riot wasn't moving how I wanted to, I was also losing a ton of money. You don't need to be buying it early. You could, if you have the capital, you can buy that far of a contract. You can go all the way down to like an Apple 105 call if you have $4,000. So your delta is $91. Your theta is 1 cent, 15 cents, or $1. I'm not good with math right now. I think that's $1. Don't mind me. But yeah, that's just what I would say. So I would just put an expiration for next week just to kind of show you. But when you go to puts, right, see how Apple is green for puts, because remember, you put the phone down. A put is when you make money off a stock going down. So see all these puts, they were doing really good today, up 40%, 20%, 30%, really good returns in a day. That's a really good return. And puts, though, when you're looking at the Greeks, it's going to confuse you because it's negative. The delta is negative. The theta is negative. It's okay. read it the exact same way. This is the amount of money you're making per dollar. This is the amount of money you're losing per day. It's only negative because it's a put, but don't look at it like, Kelly, I'm going to be losing money on puts? How does that make sense? No, don't look at it like that. I'm telling you how you would read it. So don't worry about that. But if you want to place a call, you're going to go to buy call, and you're going to, let's say we do decide we want this 147 because we're like, you know what? I believe Apple will make it to like 145 next week. I like the Greeks. If it makes a $2 movement, I can make around $50. That's really good for an $80 investment. Or I'm going to show it to you this way. It's really good for let's say you have $1,000 to risk. So use this 10 contracts. So you pay $820 for this $82 contract. Cool. If it moves up, we'll just move the price up by 50. Let's say it's worth 50 more. So that would be like 130. So I would just edit that to be 1.30. And you can see that you'll make $500 if it goes up, and boom, that's kind of how you calculate it. So let's say you're like, I don't like that. I want to buy just this 37 150 call. Cool. You could do that too. So exit this 147. We'll continue with the 150. You buy 10 contracts. It won't be at this price. It's going to be at 0.37. So you pay about $370. Let's say, depending on our Greeks, and it should be worth more, but it'll move $26 if it gets to 145. Then, boom, what'll happen is I'm going to move this up $26. So 37 plus 26. I'm just going to do plus 20 is 57. So I'm going to do like 63. And so you turn, what was the initial price? About $300 into $600. And they could do that in one day because Apple can move up in one day. Over the past week, it's up $5. Over the past month, it's up $16. So imagine if you were holding that contract. Remember, it's going to become worth more as the stock approaches your strike price. So really, if it got to like 145, this wouldn't actually translate directly to $26. It'd probably be worth about like 40 in terms of profit per contract and stuff like that. So that's how you can utilize options. And let's say you wanted to place this, but let's say we're trying our first option, right? So I'm going to keep this one. I'm going to go ahead and exit this actually. So let's say we're trying our very first contract. You felt confident in this 147. You said, okay, I'm okay putting up around $80. Well, let me be a little bit more conservative. I'm okay putting up around $50. The Greeks are cool. I kind of like them. I make about $8 per dollar. I'm cool with that. I risk this 50 because I believe in Apple. You place it by going to continue. You just buy one. Of course, you can get it filled at 48, which will probably get filled. Maybe you're like, nah, man, I want to pay 47. It could get filled there too. But to be safe, we'll just buy it what it's listed at. This expires because I know somebody will ask a question about it. The expires, it doesn't matter. It just means if you place this call, when do you want it to fill? If it doesn't fill immediately, you could say, well, it can expire at the end of the day. Tomorrow I'll try and buy it. Or you could say, no, for 90 days, I want this to go through. I really feel good about this contract. If it ever gets to this price, I want it to fill. Know that contracts will move. So what's important to know about them moving is if Apple may run up and this will never be worth 48 cents again per share. So you do not want to be sitting there. I want my stuff to get filled immediately, so I don't even worry about this. And then you press review order. It would load, and then it would say you're paying for it. Cool. You say, yeah, I want to pay for it. That's me. So you're paying $48 for the right to buy 100 shares of Apple for $149 per share by July 16th. If Apple shares aren't $149 or higher on July 16th, this option will expire worthless. And you're like, okay, cool. That's completely cool if it expires worthless. Essentially, you would just press submit. You can sell the contract before it hits expiration. You do not have to wait till it hits expiration. That's why I said the expiration date is honestly just a safety net. If you buy an expiration for July 16th, but you want to sell it on July 12th, go ahead. If you buy an expiration for November, but you want to sell it on August 2nd, go ahead. Just take your profit where you see it. Don't be greedy. That's how you win in the options game. So that's essentially what you do. You'd press submit. I won't do it though because the market is not currently open. And let's say you were selling. So on the selling side, it'll look the exact same. It'll say, how many contracts do you want to sell? You have one contract available. You'll say, I just want to sell one, bro. I'm cool with my 48 bucks. I bought it at $22. So I've made good money. Cool. So then you would go ahead and you would say, boom, 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 boom. Well, they wanted a 49. Like I said, sometimes I'll go here and I'll put 52 and it fills and I make $3 more. Or you could just say, you know what? I really just want to get it off my hands. I'll put it at 47. It'll probably fill when you're selling. But it'll give it to you at around 48, the same price. You could put 49 and match. You know, you can mess around with it, you know, so that you can make sure it fills and you do secure your profit. You can also look at who wants it. So 15 people want it at this price. 15 people are selling it at this price. 20 people want it. So 47, 48 should get you a good fill if you are selling that contract. It works the exact same way. You'll be completely cool, completely great. So just to mess around a little bit more with the numbers to kind of show you, I'm just going to put this at 0.01. Oh, well, this would be 0.01. So let's say I buy 10 contracts worth, $10, but I'm going to put it worth 10 cents. So I spent $100. Let's say this contract decides to go ballistic and it runs up to 50 cents, right? You turn $100 into $500. That's how options works. As you can see, you know, going up though, or going up front, the max you can lose is $100. So max loss $100. Profit is unlimited. So people say, well, Kelly, how can the profit really be unlimited? Just like that. It can literally just be unlimited. So I remember when GameStop was doing its crazy thing and a ton of people were making money overnight, like insanely. I saw a GameStop contract. It was literally 1 cent at market close. 1 cent at market close. It was like 115 call. And GameStop was like a 30 something. I don't know. It got up. When market opened the next day, GameStop had ran to like 150. Those contracts, I'm going to tell you how much they were worth, went from $10 to $50. So I always think to this day, Jesus, if someone had bought just $10 worth, they would have turned $10 into $50,000. That is an insane story to tell. Somebody did it. I know somebody did it because people own those contracts the next day. But that is insane to me. So that's just how lucrative and profitable options can be. They can be super profitable, super lucrative. And if you plan it right, if you plan your risk management right, if you maximize your profits and minimize your losses, you will be good. Always trade at the stop loss. I don't care if you go in saying I'm willing to lose everything behind this. Please don't. At least keep a little bit of your money. Every dollar counts. There's no dollar to somebody that isn't ugly. If I gave you $1 right now and you said no, I'd be very shocked. It's a free dollar. But yeah, that's what the market does. That's just a very, very quick, not fully in depth, but very quick options breakdown. It should definitely get your foot in the door. Definitely help you with the basics. And yeah, you should be able to understand everything. If you have any questions, hit me on Instagram. It was great filming with y'all, talking to y'all, and I will see you guys later.